Greetings, Dr. Jeffrey Scott, and this is my weekend market update for Saturday. I guess it's February 7th, 2026. Interesting week we saw. I think I had a better day on Friday than I had the entire last 14 or 15 months from a percentage and absolute dollar move. And you have to ask the question, the market staged a huge rally. Does this mean it's over or not for the correction? Again, my name is Dr. Jeffrey Scott. My email address is marketmripro@gmail.com. I respond personally to any questions, comments, concerns, advice. Google Groups called Top Down Trader, and my website is called marketmripro.com. This is for educational purposes only. Anything I talk about should be taken in the spirit of education and not investment advice. The intent of the video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk. You are solely responsible for any investment decisions you make. I may own or intend to sell or buy any stock mentioned in this report. Trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. And I have tools in multiple platforms. For my Market MRI Pro weekend updates and nightly updates, I typically concentrate using my app, but the tools are similar across the different platforms, although each platform has some differences in capabilities. If you're looking for the wealth charts video, you'll see that sometime later tomorrow night. Typically, I do this one on Friday or Saturday, and I do my follow-up with wealth charts on the stocksanddocs.com website. And I do that typically after the futures come out, so after dinner on Saturday night or Sunday night. My Google group, I pitch it all the time for a reason. I don't keep a mailing list. I am not a traditional educator who's got a Discord site and a big mailing list with thousands of people and who's going to be constantly selling you stuff. I just don't do that. But I do want to invite you to some events I do. If I have a special on my products, I like to let you know about it. So I keep the Top Down Trader Google group for notification purposes. And I did put out a note Friday talking about how I was going to play the bounce. I'm only going to talk about the Eureka and Phoenix today. When we did the program on the 31st, a week ago, I went through several of these, and then last year I did something on all of them. But I want to call out two of Ian's teachings tonight. Today, the Eureka and the Phoenix. Now, Ian, like I, and no wonder I do it because if I could mimic Ian, I'd be very happy because Ian was very successful in what he did. But Ian spent a lot of time looking at the top-down perspective, and he wanted to develop a mathematical calculation that could be programmed in software that would do a lot like the follow-through day does for O'Neill, and we'll talk about that as well, and to use it as a signal that maybe the coast is clear and it's okay to get back into the market. Eureka is the bullish signal, the Phoenix is the bearish signal, and O'Neill's signal was called the follow-through day. The Eureka is calculated on either the NYSE or the NASDAQ. When it triggers, it indicates an extremely bullish day. When it follows a bingo, which is typically you've had a big sell-off and that's the baby out with the bathwater signal, it predicts a market reversal to the upside. If it occurs after a large run to the upside, then start to think about irrational exuberance. I plot it on a lot of my charts I look at, but it's only calculated on the NYSE or NASDAQ. It gives me conviction of what the market is doing. And you could see it includes advanced issues to declining issues, advanced to declining volume, and the ARMS index. The Phoenix is the opposite. It's calculated on both the NYSE and the NASDAQ. It indicates an extremely bearish day. If you've had a large upside move, it often predicts you're going to start going to the downside. If it occurs after a major run to the downside, think irrational exuberance to the downside, and a reversal is near, so it's counterintuitive. And again, like the Eureka, although I may have them on any chart, the signal's only calculated from the NYSE or the NASDAQ. So I'm going to show you that we had a Eureka on the NASDAQ, and that it could be a sign that the market is going to rally further, but I'm not sure it is. And we're going to talk more about that in a few minutes. The follow-through day. This is a technical signal that confirms a market correction has ended and a new sustainable uptrend has begun. It helps us identify when the big money starts to accumulate. Just a couple of criteria. It has to occur on day 4 or later of a rally attempt. So day 1 is the first day a major index closes higher after a new low. I think on the NASDAQ, maybe we can consider Friday the day 1. I'm not sure if we fell enough to have a follow-through day, but maybe we did. And then a major index, the S&P 500 or the NASDAQ, must close with a significant gain, typically 1.25% or higher. And volume must be higher than the previous day. Now, again, I don't know if I've said multiple times, bottoms don't form near tops. And I'm not sure we've had enough of a sell-off to even think of a follow-through day. But I'm just putting it there because I'm going to look for one. Strategic action, the follow-through day acts as a green light to gradually begin buying stocks. Don't buy the index, but buy leading stocks with strong fundamentals that are breaking out a proper chart basis. Why is this important? No bull market has ever started without a follow-through day, but roughly 25 to 30% of these fail. If the index undercuts the low of the follow-through day, cut your losses. And this is taken from William O'Neill's Confirming a Market Bottom. Now, one of the things that would make me think the market was going very much lower would be if we had a recession. Now, all the things that we're hearing on economic news sounds like the only recession we have is in hiring and that the economy is humming. I can tell you as a larger employer, we're probably not hiring as much, but if we go back 2 to 4 years ago, we had a lot of employee turnover after and during COVID. It's almost as if COVID empowered the employees because there was a shortage of good quality staffing. And so people were leaving their jobs and getting bigger jobs, better offers very quickly. I think what's happened in the current environment is that the power is sort of switched back to the employers, and that we're not laying off many people, but not very many people are quitting anymore. And so we're hiring less new people. So that will start to show up in some of the employment figures as I hear this more and more out in the marketplace. Less turnover. That's actually good because nothing's worse than training somebody in a highly skilled position and then losing them because they're often going to work for others in the same field. So the one thing that would throw this market to the bears would be a recession. Now, the concerning thing is if you go back to the 70s, every time you cross below zero, meaning inverted the yield curve, once you cross back above, there's a period of time and you get a recession. Well, is it different this time? And those who come to my live meetings know that whenever I think that, I know I'm setting myself up for a problem, because typically it's really never different this time. If you look over on the other side at the 10-2, again, just like the 10-3 month, always is followed by the gray band, which is a recession. Now, during recessions and before it, we see a run up in credit tightness. We have none here. So that makes me feel very comfortable that there isn't a lurking recession. And if we looked at the last Philadelphia General Activity Diffusion Index, it came out in December at 12.6. And the recessions typically occur when you're below -20. So we've got one coming up in a little bit less than 2 weeks. We'll see where it's at then. So doesn't look like we got anything imminent. What we do have is a lot of news and earnings. So a lot of Fed head speakers this week. So it'll be interesting to hear what they say about anything. What do they think about the economy, inflation? New Fed head probably won't say much about that. You've got some data that's important, NFIB optimism, the delayed monthly employment report from last week, some jobless claims, and the CPI. So there's quite a bit of stuff to come in. This is from January. What you also will get are some delayed employment and other data. The other thing to remember is we are still in the heart of earnings season, probably have a couple more weeks to go. And this has been not a forgiving earnings season. I'd say it's been a rewarding, both positively and negatively. If you are perfect, which means you beat your earnings, your sales, and you guide higher, you've gotten big bumps. But if you have miss on any of those, or you talk about high capex because of AI, you've been clobbered. So won't go into too detail, but you could see with Coke and CVS and Robinhood, Astera Labs, Tuesday will be big. Shopify, Vertiv, AppLovin, Albemarle on Wednesday will be big. It'd be interesting to hear what Astera Labs has, as this was a darling that sold off with the rest of the software stocks. It is a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. Let's go take a look at the charts. So I use my tool called Market MRI Pro. And give me a second, I just want to open all the windows. All right, so we're going to start in the daily briefing. You could see the symbols that I like to track intraday when I look at my product. The 1-day close, open, high, low, percent change from the open. Interesting, they all were much higher than they were at the open. That's nice to see for the indexes. 5-day change, you can still see Bitcoin, although it was up almost 10%, was down 16% over the 5 days. You could see that the leadership over the last 5 days on equities was Russell and Diamonds, both over 2%, while we lost almost 2% on the Qs, and the spiders were down. And you can see where they closed in their trading range. So Bitcoin up almost 10%, but down on the week. Russell up 3.5%. What does that mean? It means that it was down on the week going into Friday and was able to reverse it by 1.5%. Diamonds up 2.47, was kind of flat going into Friday. The Qs were up 2.11, which means they were down over 4% before Friday. And the spiders were up 1.92, which means they were down, almost 3.3% before Friday. So Friday was a big reversal day. Does it mean it's over? That's a question mark, not a statement. Dollar was down a bit on Friday, down up 0.6 on the week, and volatility was down quite a bit, 5.89%, was up a little bit on the week. If we look at 12-month or 52-week new highs minus new lows, you could see that the NYSE is very strong. You could see that we're positive now on the NASDAQ, but unlike the NYSE, the NASDAQ still has quite a few new lows to go with their new highs. Participation whether you look at sectors on Friday versus Thursday, industry groups on Friday versus Thursday, and regardless of which index, big improvement. And the one that really I think is outstanding is 83% of the S&P 1500 were up, 78% of the NASDAQ, and 82% of the NYSE. So we had massive positive breadth on Friday. If we look at the S&P 500 sectors, what was working? Tech, which was down on the week 1.91, was down almost 6% before they were up 4.06 on Friday. Industrials were up 2.86, materials 2%. The only S&P 500 sector down was communications, which was down 0.39 and finished the week down 3.6. You could see the 1 month and the 2 month, 20-day, 50-day changes here. And interestingly, really tech's been down on the month. From a theme-wise, almost everything was up. Blockchain 8.6, uranium 6.71, a pretty big reversal. Both of these still negative on the week. Silver was up 5.92, metals and mining's 5.91, 5.4 on semi, 5.3 on gold miners, Norway, which has got a lot of minerals, 4.93. And if you look at what wasn't working, well, everything was positive in the themes. A very broad-based positive day. Now, one question would be, well, how were the volume? So I like to look at market surge, so I have consistent volume tool. And unfortunately, despite the massive rally, volume was less than average on the NASDAQ and the NYSE. Takes down some of my enthusiasm. If I look at the timing model, the weekly model, we look at the red and green here, buy on the spiders, buy on the Russell, buy on the diamonds. We lost the Qs this week. And the sad thing is we are so close to turning positive on the Qs. But, for the first time in quite some time, we're wobbling on the intermediate timing model. The monthly, pretty certain we're going to see all buys, which we do. So the longer term, intermediate term are mostly buy. Like I said, we're a little wobbly. And if I look at the dailies, it's not the same because we've lost the Qs. We've lost the spiders. We're going to have to flip the bongo for it to change. And likewise, we lost the Russell. So this is not, to me, just a run-of-the-mill pullback in an uptrend, but probably represents something a little bit worse, at least a bull market under significant pressure. How will we know if it's more than that in the beginning of a down market? Well, we'll just see how it plays out. If I start to lose others on the weekly charts, that would argue that this is worse. How will we know if we're back into a big bull? Well, we'll look for that follow-through day starting on Wednesday. Wednesday. We might also be looking for additional Eureka signals. But I'd be looking to take out the prior highs would be the most convincing thing. And right now, only one of these has taken out the high, and that's the diamonds. If we look at the US index ETFs, so I drew a new line in, oops, it's not on this one. Oh, it's going to be on the Qs. So we pulled down again to the 100-day moving average. Can you make that up? Started plotting that because that's what it looked like it was going to do. Such a big move up almost 2% on the spiders that we retook the 17 and the 21 EMA. Now, the good news is that's a great move. We're not far off of all-time highs. And maybe we run up and touch them. But this is now the next thing to think about is seasonality telling us what to expect? which is to see the markets weaken around the 17th. So a run up into the 17th would fit seasonality. So far, it looks like that's what's happening. If we look at the Qs, what I thought was interesting is if I take a trend line and I run it from the bottom here through the bottom there, all we did on Friday was retrace to that trend line. Thought that was kind of interesting. We'll see what it means. Actually, I'm going to redraw it. I'm better off just deleting it. So are we going to fail at that trend line? Well, ask me at 9:30 in the morning. Or better yet, Friday at 4:15 p.m. But that's the bad news, is we still have to get above this trend line. We've got to get above the 100-day moving average. We've got the same seasonality, which suggests a short-term peak on the 17th or 18th of February. And unlike the spiders, we're a ways off of our all-time highs. Just to remind me, that's how far away we are. On the spider, just to do the same thing, if I look at how high we touched, it's up here. And if I look at the close, the all-time high on the close is back there. We're not that far away on the spider, but we are on the Qs. We look at the diamonds. Well, the diamonds are the leaders right now, and the diamonds set that all-time high. Again, same seasonality. Do we go up for a couple more days before we roll over? Don't know. Could happen. Great day up 2.47 on Friday. But these are high volume days here, and we're nowhere close to that down here. If we look at the Russell, wow, the Russell. Here's what happens when you get a new high on low volume. Had a shooting star new high. So that new high was immediately followed by a sell-off down to the 50 and a bounce. So everything's behaving, but like the others, it's got the same run up into the middle of February and a rollover pattern. So do we get a chance to test the new highs first? We might. And oh, by the way, I'm not saying that the market has a calendar and that they know the 17th is the wrong day. I'm just saying that when you look at a 5-year, 10 years, all seasonal, all date years, and 5 years, we peak at the same time. Well, kind of tells me something, doesn't it? But right now, Russell looks like it's going to go threaten all-time highs. Volatility. What I don't like about volatility has been that this trend line continues to go higher. And yes, we had an intraday reversal, but that's not a spike. This is a spike. That's a spike. This is nothing. And we're still well above resting. I think the VIX tells me we're not out of danger. And the dollar is trying to rally back up to the moving averages. But keep in mind, those are well off where it came from. So not a concern to me. If I look at commodities, and these have been the wowzers of the market. These have been so strong up until the last couple of weeks. It's still hard to believe the sell-offs that we've seen. Gold, massive sell-off, probably consolidating right around the 50. Silver, if it's lucky, the same thing. You know, if you go back to, I don't know if we can go back that far. Let's see. The last time silver did this was it 2010, 2011. Let's go look at it. I can't remember the exact date. Yep. This is the last time, massive run up. This was back in April of 2011. You could see that it just went sideways for several months. And in fact, it really took years in the better part of a decade and a half to get back to those levels. So I think it's unlikely to see silver go back to where it came from. So I'm not sure that I would be chasing this based upon history. Oil is really tied to geopolitical stuff. Iran talks on, oil drops. Iran talks off, oil goes up. Ultimately, maybe we see some supply come in from Venezuela, and you could see seasonality as oil's friend up until March. Natural gas, it didn't feel like a climax run. I wonder if that's what this was, but it ran up and it's come back down and now it's struggling to get back above the 200. And then Thursday saw big sell-offs or drops in yield. You could see Friday we bounced just a bit, 0.1 on the 10-year, and if anything, really flat day over day on the 30-year. They came down as the market weakened. Look, to me, the fact that the curves are now down over the last 10 days, from here, whatever, 15 days, 13 days, tells me they weren't too disappointed, that the bond guys were not too disappointed by the Fed head choice, because the long end of the curve, the 10 and 30 years, is probably tied more to the bond markets than it is to any specific cut that the Fed's going to do. So this is good. We didn't lose the 10 and 30 with the choice. Bucket briefing. Well, this was important because this peak here at 29% on the prior bar was how many stocks in the NASDAQ were below the Bollinger Bands. And what happens when you have too many below? You revert to the mean, and now we're down to just 10%. We had a similar number here. What was the number here? My mouse is in front of it. I think it was 24%. We're below the Bollinger Bands. Now we reverted to the mean. Interesting that NYSE and the S&P 1500 have 14%, 19% above. It's an ebb and flow. None of this is a signal, except we did say on Thursday that you would see a bounce in a few days. I personally didn't think it was going to be on Friday, but I'll take it. Now here comes the question. Have we had enough damage to say that we've had a sell-off, and that Eureka, which is this green bar, is telling us that we're done going down? Personally, I don't think so. Now let's just go back to April last year. When I pick a time, it's going to be in the center of the chart, so I may have to move it a little bit. Oh, okay, let me try that again. All right, this one I don't have to update it. And what I wanted to show you was that there was a lot of damage in the market last year. And you saw some of these Eurekas coming in on short-term strength that ultimately still rolled over and led to the bottom of the market. You saw the same thing here. I got a call, we'll just call him Simon. I used to refer to him, still do sometimes, as my mini-me at work, except he's back in practice. And I also have my real mini-me, which is my son, Justin. Before the markets open on Friday, and each day for the last 3 or 4, I've heard how much money they've lost. They're going to have to work until they're 100. They're never going to be able to retire. And then what do I hear at 9:45? Is it time to go back in? Well, they never left, so they're still in. And I think a lot of people live that. And I don't think that's, obviously, I don't think that's the way. You need to have objective signals. So I'm pointing out that we did have a Eureka here in green. If I called the Hindenburg, I was wrong. Eureka, remember I talked about Eureka and the Phoenix, that it has occurred after the Hindenburg Omen on a reversal day, reversal into resistance, and doesn't mean this is over. So I don't think this is over. We're not at any type of a big move down of stocks above the moving averages. You got new highs more than new lows, positive AD line, up, down volume. We didn't get oversold on the 13-week high-low oscillator. I don't know. I just don't feel it. I would have felt better if we undercut that low or came down to touch the 200. So my guess is that this rally fails and we go lower, but that's just a guess. And what we've seen in the past, we can go up to that 50, maybe even break the 50 and still fall. But I am thrilled to see a Eureka. I was wondering if we still had them in the program because I hadn't seen one in a little while, but I'm not sure we're out of danger yet. So the NYSE all-time highs. Again, bottoms don't occur at highs. The NYSE is getting toasty on stocks above the major moving averages. It's not yet at an extreme. You can see we're here, and an extreme is up here, but it's something I will continue to watch. And like the NASDAQ, we have had confirmed Hindenburg omens, and therefore we have a lot of risk there. But I would say new highs are mitigating that risk. On the other hand, we are in a downtrend. Now, we've got lower highs and higher lows here, so we can still do whatever we want to do. But I would look for lower lows before recovering. Now, what will change my thoughts? Well, look, I'm just guessing, hypothesizing. I think if we take out those highs, obviously we're fine. Doesn't really matter because if my weekly timing models on the NASDAQ turn bearish, then I'm going to be out of the market even more and raise more cash. And if the dailies turn bullish and the weeklies stay bullish, I'll add to my positions. But as I step back and wonder, I'm guessing that this is a bear market rally and not the beginning of a new bull, or it's a bounce. Same thing. We shall see. Interesting charts. If I look at some of the other breadth charts I like, 83, 89, 85, and 59% of the stock of the oscillator, that's the score between 0 and 100 of the 13-week new high, new low. Those are neutrals. We are not extended. We're not broken down on any of those. And you could see bounces on the RSIs. You could see the AD lines going up on several of them and the stocks above the moving averages. I don't think we're done. I just don't, because we haven't got sold off hard enough. Doesn't mean we're going down. And the best thing I can do as a trader and investor is think about where we're going, but trade the market I get, not the market that my signals suggest I'm going to get. If we look at the ratio charts on the sectors, easy to see the winners: materials, energy, staples, industrials. Those are the leaders by the ratio charts, the ones that are outperforming the spider. Sometimes I like to look at them as regular charts. So let's go into this one and let's blow these up and just comment on them very quickly. Bitcoin, trying to stage a reversal. We'll see. I think if you look at the chart of the NASDAQ and the Bitcoin on this sell-off, there's a lot of overlap. And so I think Bitcoin may be telling. Technology, huge bounce on Friday, but still in a sell mode below the moving averages. Discretionary, broke down on Thursday and Friday in a sell mode below the moving averages. Communications broke down, while industrial set all-time highs. Obviously a buy. Financials are kind of neutral, sitting on the moving averages, while energy remains in a buy. And materials are just off all-time highs, sort of consolidating in a buy. Real estate showing its head as a buy. Utilities, similar but kind of stuck in congestion, more bullish than bearish. Staples, one of the best looking performers. And then we have healthcare. Now, one thing in healthcare is barely bullish. All right. And if I look at some of the favorite stocks or widely held stocks, probably going to have to build the anti-FANG chart because FANG stocks are not holding up. Amazon, big breakdown on earnings miss and CapEx spend. Nice finish though, closing at the high of the bar. I actually bought some around 200 when it was reversing. Apple trying to regain prior highs, looks good. Google actually broke down, closed at the highs. Inside bar, we'll see what Google does. It's come off its luster a little bit though. Why? Because of earnings. And not because of earnings, but I think because of the CapEx spend of the group and sentiment related to the others. Meta, big gap up on great earnings. They've given it all back and more. Netflix still got to deal with Warner Brothers and the regulators and getting rid of Paramount, so it's still in a world of hurt. Tesla, one strong day does not end a bear market. So, I should hope that this is recording. Yep. So we'll have to see what happens, but at least like everything else, it had a bit of a morning star, big move on Friday. NVIDIA earnings are coming soon. I continue to think it goes sideways until earnings. Who's the big benefactor of the CapEx spend? I think if they stop talking about how much money they're giving OpenAI, they're going up higher. And then we got Microsoft that just is riding this trend line down lower and lower. And yeah, it had a nice bump on Friday with everything else. Not yet. Lebu got back in, still in a sell signal, retook the 50. Had some, one of my components of it, ROIV, had a really good day on Friday. Pharma breaking out to all-time highs. I mean, you look at Merck and Bristol Myers and AstraZeneca, a lot of strength in pharma. Is it because it's defensive? Data centers had a big bounce at the logical place, and no surprise, we saw a big improvement in a lot of the data center related stocks, such as uranium. And defense is setting up again, and it might be time to look at one of the ones we talked about a month ago. HWM looks like it's getting ready to run again. So now let's go into the JAS layout. From a top-down perspective, and with markets as volatile, I don't know how to use it. It's a lot tougher. What was the leadership on Friday? Tech, industrials, and energy. Boy, does that sound like a data center type of a play. These are all the industry groups in those three sectors. We rank them by performance. Well, there's obviously something is wrong in asset management because there's no way you have a 255%. So I think it's because of this one. Oh, I'll keep it in, but grain of salt, 2, 3, 4, 5, 6, 7, 8, 9, 10. We'll go to 11 just to be careful. Everything had a 6% or more move. Whoops, lost these guys. All right. Now, these are the stocks from these 10 industry groups, and we can rank them by percent move, or we could rank them by bullish impulses. And then we might want to make our list more manageable by throwing on a $5 and a 500,000 share filter. Oh, I messed it up. My bad. Let's hit these again. I guess we fixed the problem because we don't have that one up on top anymore. All right, so we got 202 stocks ranked here. Let's take a look at some of these. United Airlines. Well, I was shocked how good airlines looked today or this weekend. And I'm not typically a fan of airlines. So United Airlines pull back to the 50, a huge move. They got to love cheap gasoline. They're looked at $1.31 versus 91 cents. So that's a huge growth. No dividend. The next quarter, they're projecting 463. I like Delta and I like Southwest, but this one looks fine. STRL is a infrastructure play, sort of a cup, handle, and a breakout. STRL. I like that one a lot. That made it to my buy watch. PRIM is another infrastructure play. Just highlight it. Specialty contractor. Could be involved in building data centers. So you have a nice breakout here. Seasonality is okay. You look above, high jumps 90, it's not overly extended. Relative strength breakout, OBV looks good. You got momentum breakout and volume and a CPR. Okay, that one looks pretty good. I don't know what I'm doing that's resetting my top 10. VNet, pullback, breakout, not that exciting. Yeah, there's something going on. I probably need to turn it off and turn it back on, but I don't want to do it. The point is, the strength here is tech, industrial, and energy, but there are a lot of strength. And then as a top-down investor, I can identify the leading industry groups and then go fishing inside the leading industry groups. If I go to the impulse layout, I have 3,746, and a little treat to come in a second. The A plus scan is a very tight scan, and it's looking for a specific signal. It's looking for, well, this is bizarre. All right. What I'm going to do is I'm going to pause it and restart the program. All right. This scan, the A plus scan, is trying to identify high momentum stocks taking off. It requires the weekly bongo to be blue. It requires the two dots above the squeeze. Now the squeeze is yellow, and when it comes out of the squeeze, it's green. I'm not sure why there's a green dot there, but there are the double dots above it. These guys make, I believe, the Invisalign. They had a big breakout, but they're getting extended. Probably not my favorite one. APG is this oil services? Let's see. Specialty and industrial services, safety, specialty and industrial. All right. Beautiful uptrend, little pullback and a breakout. CPay, CorePay is a payment platform. Exact Sciences, I think, is a takeout, so we don't care. HNRG, Hallador Energy, so you can see what it does here. Steam coal in the state of Indiana. Seems boring, but coal might be coming around. And you could see here, it's going to have a penny versus a loss of 2, so that's an improvement. Pays a dividend or no dividend. No dividend. All right. All these have to have the blue bongo. It has a daily bongo. It's got the double dots above the squeeze line here. Relative strength and OBV. Henry Schein is a distributor. Think smaller than, but in the same basic world as Cardinal, McKesson, Cencora. Big breakout here. HTHT owns a bunch of hotels in China. I like this one more because this one is not extended. High jump is 86. I don't want that line. Let me take that line out. And if we put this line here, we broke out to, at least for now, all-time new highs. Even higher than that. So I like HTHT. I don't mind buying new highs, especially when seasonality is good, good volume. Let's look at earnings. 41 cents coming in against 14. So that's a huge increase. Multiples 31, 4.7% dividend. Tends to have surprises the last couple of times. So HTHT looks probably more interesting than most. I think ALGN, I always like. This one moves a lot when the markets and the economy get stronger. NVST had a huge move on Friday, and because of that, I don't know why it says HWM. I think it's going to be 100 on the high jump, so I'd be careful with it. And it was up 38 cents versus 24, so that's more than a 50% growth on a PE of 24. When I see a move like that, it's hard not to chase it, especially when it closes up here. I'd still expect it to pull back and maybe give me a better opportunity. THC, Tenet Healthcare, earnings are this they're this week, February 11th, 405 versus 344. So that's kind of a nice increase, doesn't pay a dividend. Just kind of feels like it's around the top. So that's one of my favorite scans. Another of my favorite scans is the A scan. And this is my more typical pullbacks in an uptrend. Typically requires a squeeze. So let's find one that I know looked interesting. ECG. Now, what did I? Okay. There must be a bad tick because if I move it one more day, kind of a sideways mover here. Let's look at the weekly chart. Yeah, too much funkiness with the chart. However, it did have a pretty strong day on Friday. It's also a recent IPO. Taiwan Semiconductor, I think looks great here. I believe earnings are out, but let's check that. Earnings are out. Looking for 326 in the next cycle versus 214. That's a big gain. It pays a bit of a dividend. What percent is it? A little bit less than 1%. Certainly one of the leaders here, nice uptrend pullback and a breakout. I like that one a lot. I don't know anything about SYRE, but I do notice that it's been basing here, and a breakout of that line might be interesting. I would do some research. Lilly earnings are out. They make a lot of money, but now everybody's going to worry about what happens to Manjaro. They came in at 754 versus 532. Insight is a biotech. I love the chart. Looks like it's setting up to run again. Good relative strength and volume. So CMG, I thought their earnings were bad, and I guess stabilized some. Not a whole lot of excitement there. All right, anything else that I wanted to show you here? A lot of regional banks look like this. This is Bank of California. Many of them have had their earnings out already. He's projecting 28 cents, 38 cents versus 26. So that's almost a 50% growth. So it's continuing its growth spurt. So that could be something that's interesting, 2% dividend. But there were a lot of good-looking regional banks. And then the last thing I want to show you before I'm going to look at some of the ones that I picked on my buy watch list is a new scan. And this is a scan that, first of all, before I say anything, let me make sure this is clear. I want to clear this one out. When I did my video and mentoring on the 31st, I created a new scan. And if you have interest in how I did that, you need to watch the video. It's super easy. And there are a lot of criteria. And I thought, what is my favorite pattern to buy? And I thought about it. And I said, all right, I want a stock where the weekly bond goes blue, meaning it's an uptrend. It wouldn't be bad if the daily just reversed from a down to an up, meaning if we pull back, we're now going higher. Excuse me. I would love to have some of my impulse stocks. Remember that I got momentum, volume, breakout, gaps, two signals, the CPR and the EMS. I want to have a recent cross of the relative strength versus the spider and the OBV versus its moving average. That to me would have defined the perfect stock. So we created something, and I've now renamed it JAS Rockets in Flight. Now, the problem is there's a lot of stocks there, but that just tells you how strong of a day it was. Now, let's just take this list and let's copy it to the 1/31/2026 scan. And Praveen and I were playing around with this because I didn't think it was transferring, but it is transferring. And then let's look at, just as we create a leaders list, how would all these stocks be doing if we put them all together? You notice there's a heck of a lot of green there and not a lot of red. Holy Toledo. Think of the market that we're in. And this scan has chosen a very different looking set of stocks. So I'm starting to begin to believe that I need to be living in this list. And I call them rockets in flight because they've taken off. So I will be trying to filter this down a little bit and trying to understand more about the strength of this list. But boy, don't you want all your stocks to do that? So more to follow on this, but there's a lot of really good stocks in here. Lastly, and we're going to create this as a standalone filter in the program fairly quickly. But if you want to know what's in it, the best way is to just stop your computer, take a picture of this, and it will tell you what the components are. How cool is that? And then lastly, I want to just look at some of the stocks that I was watching, or I'll be watching. And I had more potential buys this week than I've had in a long time, and 45 of them were part of the 81. So let me just call out some. Right? Acon is a past high growth stock that's been beaten down. It's had a couple of big days in a row on okay volume, lots of blue dots coming out of the squeeze with the right picture here. I'd call that one a bottom fishing choice that might be interesting. This guy doesn't belong, so I got to pull him. I don't know. He got in by mistake. Now, why would I show you Peabody Energy? It's a coal play. And if I look at the fundamentals, it doesn't even look that exciting. Let me pull over another source. BTU. It's projecting $2.14 in 26, 363 in 27. Even if you take a 50 multiple, which is 10% of 26 and less than the growth in 27. If it hits that number, what's it worth? A hell of a lot more than $37. And so I'm pretty excited about what's coming. So I may think about taking a position in Peabody and waiting and seeing. Cruise lines looked good last week. This is Carnival. I thought the other one that I thought was most attractive was probably the other one was Viking. Nice uptrend, pullback and a breakout. So many things that looked interesting. I mentioned Delta looked good, pullback and a breakout, my type of trade. GEV, not for the faint of heart because the intraday moves it can have is fierce, but I'm back in this one, and this kind of looks like a cup and a handle and a breakout. I mentioned HWM, nice uptrend, pull back to the 50 and a breakout on Friday. Seasonality is okay. It's not extended. Here's Southwest. Hard to believe, but I guess they're projecting a lot more. Let's look at the fundies here. Revenue because of their changing of how they're booking assigned seats and charging for bags. How do we ignore this? Current multiple is 53. These are the estimates going forward. I think there's a reason why it kind of looks like silver. Couple others, then I'm going to say goodbye. I did HWM. Probably the best stock in the market right now is Lumentum. And I thought about this to myself and I said, why aren't I in it? And that was because my brain took over. And because my program, not only did it find it, but it found it and I basically talked about it on a webinar or a video because I drew the breakout and got it. I don't think I trusted this company for some other reason. This is one of those times I wish they didn't come with names on them because this thing is on fire. You're not going to find all of them. I'm certainly not either. And then just I'll finish here with Micron and SanDisk. I kind of like what Micron did. It had a pretty big sell-off and it's now had 2 positive days in a row. Do we get back into Micron? And again, I'm only pulling out this because they have more forward-looking fundamentals. You look at Micron and you start to look at where it's going. 829 and 25 versus $1.30 and 24. 32.83 and 26 and 43.49 and 27. The data centers are gobbling up all the memory and SSDs that this company can produce. Earnings growth rates here. Do you think that's priced with a PE of 34? No. And even if that PE stays the same, with that higher revenue and earnings coming in, the stock's going to continue higher. And I think you can probably say the same thing about SanDisk. I mean, these are unbelievable growth rates. Now, I've been through the boom and bust of the memory storage, and what typically trips them up is they get tripped up because of supply comes into market. I don't know how you get supply in very quickly. So on that note, I'm going to thank you. Oh, one other, TKO. I looked at the chart. Again, is this a cup and a handle getting ready to break out? It's an ascending base, whatever you want to call it. Pull back to the 50 and breaking out. And I thought, well, that looks interesting, but who cares? The earnings up here, it's going to have 12 cents versus 35. Definitely not that exciting. Why would I even care about this? Because I verify or I want to see more. And if we look at TKO here, again, this is a weekly chart, and I think you can see beautiful uptrend. After the last quarter of 25 earnings, this thing takes off. And look at the growth rates. So I'm a glutton for earnings. Always have been, always will be. So I think the most important thing to understand or to figure out or to have your own opinion on is this showing me that we've bottomed and we're going to new highs? Or the fact that we have Hindenburgs on both, we're going lower. I think that's still a question, and hence the way I titled this. Why this may or may not mean it's over for the correction. Sorry this was so long. I got ahead of myself with too many stocks.